The limit order on this is wrong. I made a mistake. You can see on the options.
Welcome everybody to today's Portfolio Builder webinar. We got a few people popping in already. Steve, welcome. Haven't spoke to you in quite some time. How are you doing? Oh, he's not at his computer right now. Oh, there he is. Gerard Henry Rodal, welcome. Let's see. Got some questions popping in. I did unmute everybody, so if you have a mic, you're welcome to speak. If you prefer to type your questions, no problem. How's it? You got your audio on, I believe. Is that right, Henry?
Pardon?
Oh, you've got your audio on, and that's great too.
Yes.
Yeah, I like to have some interactivity. Gerard, do you have your audio? Oh, we got more people joining. We got Jerry G. Welcome. I don't see an audio for you, but if you get one, I can throw it on. Oh, there it is. So you guys have a little microphone button that's green right now. If you want to mute yourself, feel free. If you prefer to place questions in the chat box, that's fine. Is my audio level good for everyone? Yeah? Okay. All righty, well, sounds good. I'm going to start off by doing an overview of our program, what our goals are. Today's trade alert. We'll take a look at some of our more advanced programs, and then we'll open up for Q&A. And if anybody's up to it, I'll pull up your spreadsheet and kind of interact with you and figure out what settings you might like to use in the platform. So the goal is basically to purchase lots of 100 shares of the SPY ETF. The reason we like the SPY ETF is because it's the most highly traded equity in the world. And beyond just being the most popular and highly traded equity in the world, it gives you the most diversification on top of that by holding its top position is only 5%. And so after that, it drops very quickly into the top 500 companies. So what you end up with is a very stable product that is connected to the entire world economy. And if the S&P 500 is going down, you can bet unemployment's going up, real estate's going down, bond yields are going up. It's really a disastrous thing when the American economy slows down. So that's why for folks who are in their 50s to 80s looking for long-term retirement income, this strategy makes a lot of sense. And half our goal here is not just to show you a very simple way to generate retirement income. We're also trying to help you avoid losing money, which tends to be one of the bigger problems for a lot of our clients is that they still think they're 20 years old and they're doing all kinds of crazy stuff. So half the battle is getting you to change your bad habits, and the other half of the battle is just to get you to see how easy this is to follow. So let's start off by looking at today's trade alert. And here's the basic idea. If we can write a covered call and collect around $100, and we can do this 3 times a week, which is another unique feature of the S&P 500 SPY ETF. It's the only security that offers 3 covered call expirations a week. So Monday, Wednesday, Friday are the expiration dates. We're not going to always get $100 credit writing the covered call, but we're going to aim for something in that general area. So you can do the math in your head. If you buy 100 shares of the SPY ETF, which now costs a little more than what's on the screen because it's been going up, your buy-in cost is around $30,000, and you now own probably the best piece of real estate in the stock market. It'd be something like owning a little apartment in a New York condo or an LA condo, and you're using the Airbnb app to rent it out consistently for income. The difference though is you don't have to remodel, you don't have to deal with tenants. The whole system takes 2 minutes per trade. So what happens if we collect around $100 3 times a week, 52 weeks a year? You can do the math. That's $15,600 just from writing a simple covered call. Now, is that as simple as it gets for generating income with this strategy? Sure, there's more nuances, and we're not always going to be going for the full $100 credit. In fact, today's trade alert was slightly under that. But I just want to point out the type of return we can make by holding one of the world's safest assets and then letting speculators guess how high it's going to go up in a 48-hour period. It lets you put a lot of capital to work in a very safe way. And while you're not going to get rich overnight, this really adds up. So whether you want to compound your profits or you want to withdraw the cash every month so that you can live on this for the rest of your life, this is a strategy that anyone can follow. And so you'll see that most of our members start off joining these webinars, ask a few questions, and then that's it. They're on their own. They can do the trade in 3 minutes, and they can do it on the run from their phone if they have a good broker dealer. One broker dealer we really like, in fact, is Robinhood, which is a $5 billion startup company in San Francisco, and its private equity investors pay for every single fee that is related to our strategy, from option assignment to writing options to buying options to the stock trades. And these days, everybody goes through the exact same liquidity pools. So it's not like we're getting better or worse fills. This is just a company that wants to try to compete with some of the big dogs. And so they are giving away free trades. They also federally insure up to $500,000. So that's one good option. We also like Interactive Brokers. Whenever I was a fancy trader, Thinkorswim was my favorite platform, but it really doesn't matter. The basics of our program has very low commission costs to start with. So that's the basic idea. For those of you who don't have $30,000 to get started, we totally understand that. We wanted to create a very similar strategy that you can follow, and this is also in our basic program. So you'll see every Monday, Wednesday, Friday, we're going to publish the 2 types of strategies for generating retirement income. And one of those is trading the TBT, and the other is trading the SPY ETF. So we'll get into both of those. The startup cost for the TBT program is significantly less. And this portfolio has still had a very similar return. One of the benefits of this is that it actually only trades on Fridays because it doesn't have those 3 times a week option contracts. So let's dive into some of the details of what we've done in today's trade and some of the trades this week. And we can look at how you might take this same idea and do it a little bit more advanced. I know we got folks like Steve who are option experts. They can whip up any kind of option trade you want. So for many people, this seems boring, but it still manages to outperform almost anything you can do. So let's go back to the top. In the beginning of your trade alert is a link to our quick start guide. So if you're not sure how to use the platform, this is a very basic video that shows you in about 10 minutes how to use the platform spreadsheet. We'll jump into that in a little bit. And now, while we don't put it in the Word document, in your email is a link to your platform spreadsheet. So one of the first things that most investors don't do, but they should do, is keep track of what they're doing in a spreadsheet and to use some sort of organization and strategy to keep you focused. So that's the first thing our company created, was basically a factory that can create these spreadsheets and issue them to all of our members. And so we'll go over that in a minute. The first step today was to cover our covered call from Wednesday. And so we had a 10% profit on the covered call because we were able to buy it back for slightly less, but our underlying asset increased in value significantly. So this was a good 48-hour period for us. The new trade alert was to sell to open. And in this model portfolio, there are 1,700 contracts. So this is a $500,000 model portfolio. You don't need $500,000 to follow the program. You only need 30. So for every 100 shares, you write 1 covered call. And in this case, we're writing the strike below the trading price. So you look at the difference that we're essentially agreeing to a 30-cent loss going into this, selling our shares, but we're pulling in a $1.35 profit. And I'm sorry, that's actually a 50-cent loss on the underlying, but a $1.35. So you take the net, we're making about 85 bucks if we get assigned. So if the S&P 500 goes up from now until Monday significantly, and the person we've sold our call option contract to uses it, we may have to sell our underlying for a loss, but we get a guaranteed profit of 85 bucks. And you can guess what we'll do Monday. We'll buy our shares right back and do this all over again. Now, if the S&P 500 is to go flat or slightly down, we may not be assigned, keep our stock, and also keep the covered call income. So that's kind of a look at what we're looking at in the next, from today until Monday. Now, how do we choose the strike price? In general, our strategy looks at where the trading volume is betting from here until the next expiration. We can see today there's a heavy load of put option volume. That's because the SPY jumped up a huge amount in the last 3 days. So everyone's betting that's going to go down slightly. So we took the 281.50 in the money covered call. If we look down, we can see when this launched, 12/10/2018. If I pull up that chart, this is important. We're going to be talking a lot about risks today and what we need to be worried about going into retirement. So for most of 2018, we were developing this technology to be able to create these spreadsheets, issue them out, and have a good organization system for investors to do very simple but very effective covered call strategies. When we launched, you might have thought that was a great time to buy the dip, but of course it wasn't. And you can see this was the Christmas massacre. So every model portfolio that we'll be demonstrating today started in this week. And our class schedule is Monday, Wednesday, Friday is our basic level program, whereas Tuesday we go to the high yield covered calls, and Thursday the emerging markets. So I'll cover all that. And so the strategy is very simple. As we look at the momentum, we write the covered call below the trading price if the market's falling, and if the market's rising, we write the trading price above. And so by doing that, it took a lot of the sting out of the downside, and it also gave up some of the profits to the upside. So you can see we're sitting on a 7% return, but we've had almost no drawdown, and that's very important for this strategy. Now, is the stock market always going to fly up, and is it always going to fly down? No, most of the time it just goes bumpy and nowhere, and that's when covered call writing really shines. If we go to the TBT trade, this has been an insane move in the bond market for about 30 years and keeps on going. The general idea in this portfolio is that America is creating too much supply of treasuries and that the demand will eventually not meet the supply. And so we've seen our deficit just skyrocketing and there's no end in sight. The TBT is a unique product. Now we could be doing the TLT, but because of the small amount of volatility in the TLT and the nature of it, the yield you can write making covered calls is tiny. So we chose a very related product called the TBT ProShares Ultra Short Lehman 20-Year Treasury. So our expectation is that the long end of the treasury curve will continue to steepen. And in doing so, we can write this covered call and not have to worry about the underlying asset going to zero. So that's the key metric with this program is, can we find a product that is stable and we can reasonably track? And so, of course, the bond market is extremely related to the S&P 500. Now, despite this really quite remarkable crash in treasury rates in the last 2 weeks, our portfolio is still doing great on this program. It did lose some of its gains. It was outperforming the S&P 500, But because we continue to write the covered call, we've protected the position and only had a small amount of drawdown. This was almost breaking 10% a few weeks ago, dropped to about 3.5% during this pullback and is already back to 6.5%. And the nice thing about any kind of volatility in our underlying asset is that it does increase the covered call income because of the option premium rising. So that's a little summary of today's trades. On the TBT, we once again are continuing to protect against this lowering yield rate in the Treasury. So we wrote the 32 for, in our screenshot, 74 cents. So you may have got a slightly different credit, but that's the strike price. So we're playing this one defensively this week as well. Now, if we jump over to the spreadsheet, let me give you a quick walk around of how it is laid out. And we'll cover all 4 of our portfolios that you can follow. So the first thing that you do is set your allocation settings. And in this portfolio, we set the target income at 90%, the target growth at 0%, the target cash at 10%, which we're going to eventually use to hedge our portfolio if anything gets hairy. And then we have, this is actually was played around with for the demo, that's set at 0 in this one. And so what this does is it tells our software that we want to target 90% of our capital to own the SPY. Now, it looks at how much capital you have from your deposit area. So this portfolio started off with the $500,000 deposit, but it could have been just 30,000. After that, you get a trade alert. This column tells you what you need to do to get your target allocation. So it's a nifty little tool. It's very simple, and our software essentially reads this column for whatever ticker you've placed, reads if it's positive or negative, and can calculate how many shares you own. So just a quick demo, if I were to put a minus on that, you can see we now have a negative amount of shares. Okay, so this is our SPY trade. You can see we keep track of buying and selling the SPY in this purple area. And if we scroll over, we have a open option writing area. This is where we always keep our current option contract. Now we're not layering covered calls, we're just doing one simple covered call at a time. And there's the ability to be doing this on a basket of ETFs. If we thought there was a growth prospect, we could switch from the target income to the target growth and continue to write covered calls. But right now we're in a much more defensive stance, and we're currently focusing on the SPY. Down here is where we write our closed options. So every time we close it, we plop it right back down here. If we scroll to the right, we can see where we do long option purchases. So very rarely do we want to go long, and almost always it will be to protect our portfolio from downside risk. So these were some positions put on back in February and January, and they're not recommended right now. When the time comes, we will most likely cover all of these and issue a brand new trade to properly hedge the portfolio. Now, the poor man strategy, we've demonstrated with an initial deposit of $40,000. And the setting has 90% into the inverse bonds, 10% cash, and the rest are zeroed out. And you can see it issues a trade alert to own a certain amount of the TBT ETF. And the same philosophy and strategy here, except you only trade once a week. Now, does anybody have any questions so far before I jump into some of our more advanced portfolios? All right, looks like this is all pretty clear so far. So let's let's look at how you can improve the results and still do basically the exact same thing. So if you were to actually look at what the S&P 500 purchases, as well as the QQQ ETF, these are the two top American ETFs in the world, and you strip out the equities that are just too expensive for the normal Joe to purchase 100 shares, such as Google, Amazon, and Berkshire. And in fact, with Berkshire, we can take the same idea. We're trying to remove the fluff and the cushion and go to the direct source, the actual security. And so you're going to see, if you look at what Berkshire owns and you look at what the S&P 500 owns, and you pull out the best companies for writing covered calls, you end up with a portfolio that looks like this. You have Microsoft as the core position. We have Apple, Facebook, Intel, Cisco, and Comcast as our core tech. And then we have Bank of America and Wells Fargo. So if you do look at Berkshire, almost, I think it's 45% of his portfolio is in Apple, Bank of America, and Wells Fargo. If we scroll up here, you can see that we've set 23% for steady income, which targets this Microsoft position, which is arguably the most important security. Henry Wong, what is the win-loss for SPY program? Oh, got a quick question. So it's hard to keep, we're not trying to keep track of really wins or losses. We're just watching the portfolio grow consistently. There's two ways we generate a profit from writing a covered call. So it's important to know, if the stock market goes up, we win no matter what by writing a covered call. And depending on how defensive we were with that covered call, that amount of profit is dramatically changed. So if I go look at this covered call profit loss right here, you might be a little misled if you're not really understanding how the strategy works. So when we take a loss on a covered call, that's actually a great thing. That means we made a lot more money on the underlying asset. So if you were to go look at the results of the covered calls, which you have access to from your email, sure, most of the time we make 100% profit, but that's not necessarily a good thing, because the underlying asset may have lost some of its value. And sure, we're going to be doing this over and over again, so we're not so worried about short-term volatility in our underlying asset, but that's very misleading. So sometimes we make profit from the underlying asset rising, which has been the case for the last 3 months, and we can also generate a profit from the covered call. But if you were to just look at one aspect or the other separately, it might be a misleading picture for you. Does that make sense, Henry? Okay, great. So yeah, that's certainly, we'll talk about the big risk of this strategy and how it relates to other strategies, so that we can, what do we need to be worried about? And that's a very fair question, and definitely jump into that. So, okay, so let's look at some of our other programs. Tuesdays, we do the high yield covered call, and the idea is to take apart the S&P 500 and figure out what the most important corporations are, and to just purchase those instead of the cushioned ETF. And so by doing so, we end up with this palette of securities with this target percentage allocation in your portfolio. The startup cost on this is about $150,000 to end up with the right ratio of each company relative to each position. So our smallest positions relative to shares are these. So if you did want to follow this program with less than 150,000, you can turn off certain areas of the spreadsheet. So you might say, well, I'm going to start off with just the banks. And you can see the software is now going to tell you you need to sell all these other shares, which you wouldn't have already purchased. And it's going to put all your money into the banks. And so in a little bit, we'll actually play with someone else's spreadsheet and see what kind of settings you would like. This is just the default settings that I feel has the best long-term outlook. And we'll talk about trying to be a stock picker or a sector picker or anything related to beating the market and why that's not a good idea. For now, just know this is essentially the core positions of the S&P 500 and the QQQ. So by doing this, what's the value of this? Well, number one, we can get a higher covered call yield. The S&P 500 is much less volatile than these individual securities, so it offers a smaller option premium. So that's number one. Number two, by looking at the trading volume, we can get a better idea of what may happen to each individual security from 1 week to the next. So we might write our strike above the trading price for many of the securities and only below on certain. So for example, Apple was in that basket this week where the rest of them were relatively bullish. So that's our Tuesday class. It's designed to replace the Monday, Wednesday class for investors who have more capital and would like to do less trading. The Thursday class helps you diversify some of your portfolio outside of the States. So if you're studying the emerging markets, the same philosophy has been developed in this portfolio. EEM is the second highest traded ETF in the world. It's only underneath the SPY and usually head to head with the QQQ. Tons of money is flowing into this and it's going to be a very long-term trend. But what does that ETF actually invest in? Now in this case, it's almost impossible to get access to the direct securities that are held in the emerging market fund because it's investing in China, South Korea, India, Russia, and Brazil with most of its capital. And once again, if we buy the country ETF that is specific and not bundled up with a lot of diversification like the emerging markets ETF, we get a better covered call yield. This portfolio also has exposure to gold and silver. So this portfolio costs $50,000 to build. It has a 7.5% return to date, and it trades every Thursday. Same strategy, same organization, just a different palette. And so right now, that's our base recommendation is 75% in the US equities with 25% in the emerging markets. Let's take another break and see if we have any questions about these two portfolios now. Okay, so assigned versus exercised. So the call purchaser can exercise his right, and then as the option writer, we're assigned. So let's talk about when we might get assigned. That's a great question. There is a certain situation where we will be more than happy to get assigned because we're trying to play it safe. And so let's just pretend that we thought there was something very bad that was going to happen between now and the close of Monday. And we saw a tremendous amount of volume, not just trading in this put option area, that's close to the trading price. Let's say we saw huge amounts of volume on the put option side and almost none on the call option side. And we were just very concerned that something bad was going to happen in the next two trading days, this trading day and the next trading day. What could we do? Well, one option is you could invest in a call option on the VIX. But what happens if you're wrong? Your VIX loses value very quickly. What happens if you buy, say, a put option on the QQQ, a more leveraged version of the SPY ETF, and you're wrong? You're losing value at a very rapid rate. But what happens if you write an in-the-money covered call? So let's take a look at that scenario and see how we can protect our portfolio and not lose money if we're wrong. So if I thought the S&P 500 SPY ETF was going to drop, let's say $5 between now and the close of Monday, I might write this 277 strike call option. So I'm basically agreeing off the bat to sell my shares for a $5 loss. Now, why on earth would I do that? Well, the reason why is because it's going to protect my position all the way to that 277 level. And if I'm right, that call option will dramatically lose its value. And so I can collect $5, which is exactly how much I'll lose going into the trade. And so essentially, if the market goes up, we break even. We get assigned, but we get to keep the entire credit. Now, if we're right, or even just a little bit right, and the underlying asset trades anywhere between 282 and 277, we're going to be able to hold on to our shares and buy back that option contract we wrote for a big profit. And so you'll see the farther we go deeper in the money in the covered call, the less profit we're going to make if we get assigned. Let's look if we went to this level right here. Now you can see we get a guaranteed 15-cent, or rather $15 profit if we get assigned. So if I thought we were only going to crash $3 between now and Monday, I could sell the 279 covered call for $315. And if I was wrong and the market jumped up and I got assigned, which is when someone who bought a call option would exercise their right, well, then I get a guaranteed $15 profit. And so you'll note that the farther we go away from the trading price, the less our guaranteed income is. So we would prefer to be writing covered calls that are near the money most of the time, because we can get much closer or even above that $100 3 times a week goal. But again, if we're worried that there's some sort of risk, it's a very quick and risk-free way to protect our capital. And so what is the biggest concern with this strategy? And so I would argue the biggest fear would be, let me get this to update. If we look at the period from 1960 all the way to 1980, we had a 20-year rise in the Fed fund rate. And so what happened to the stock market during this period? You can see there's times where they dropped the fund rate by 50%, then jacked it up by 125%, then crashed it by 75%, and then rushed it up by 250% to get to a high of almost 20%. So what happened to the S&P 500 during that period? Okay, Steve has a quick question about what. So today's trade has the trade. It was just below the strike. I'll jump on that in a second. So what's the big risk for anyone who's trading bonds, equities, or real estate? Okay, it's just one thing. It's if the Fed raises rates, that causes trouble in all markets. And so if we go look at the Dow Jones from this same time period, from 1960 to 1980, you can see this was essentially a 20-year period where you did not make any money. In fact, if you had gone all in on the Dow in 1960, you didn't even get back to even until 1990, 30 years. And you experienced a 50% drawdown during that, even more. So our product, which is designed for folks who are 50 to 80 years old, who want to create retirement income for the rest of their life, who can't afford 30 years of losses, that's who this product's for, is how can we protect our capital? And so our biggest concern is a multi-decade bear market. What causes the Fed to raise rates? Okay, so if we go back to that same time period, it's pretty clear what causes that. Okay, from the 60s through the 80s, this is the inflation data. They couldn't control inflation. So that's our biggest concern, and one of the key things we're tracking is the inflation rate. If the inflation starts to get hot, we can expect that the central banks will raise rates. So that's a relatively simple thing that does dictate. Now, what's the case right now? All of the central banks are perplexed. For the last 10 years, they have printed more money than they thought possible without causing runaway inflation. You know, we get stories about Germany, Zimbabwe, all sorts of hyperinflation stories. But they've together, the ECB, the Bank of China, and the United States have almost doubled the money supply in the last 10 years alone. So why isn't there inflation? And so we could get into a lot of details about, you know, the arguments for both sides of the direction. But at the end of the day, this is the key metric to follow. Is if we start to see inflation, we have to get a little more concerned. And that's when we would actually buy the VIX and call option, and then start getting the out of the money put options on the QQQ. Okay, so let's take a look at today's trade for Steve so we can just see the current trade. So again, I want to point out that the general mindset for this product is always going to be preservation of capital. So I'm very happy to write an in-the-money covered call, knowing full well we're going to miss out on some of the upside if we're wrong. You know, right now inflation's low and rates around the world are low, and you'll still see that we continue to make safe trade after safe trade whenever the market tells us there's a risk. And so if we look at today's trade alert, let's first look at what happened. So we had this huge run from 278 to 282 in a period of 2 trading days in the open. So it's a big run up. What did the option market predict is going to happen? Well, it was a little bit of a mixed bag, but we can see the heavy skew today was on the put option side. There is a good amount of call options over here trading at 85 and 60 cents. But there's even more trading at $1, 80, and 60 over here on this side. So we went one strike below for $1.40. So let's look at the economics of that trade. So right off the bat, we're giving up 50 cents of profit from the current trading price, but we're taking in $1.40 credit. So this is not a super defensive trade, and it's really not a super bullish trade. It's just a very neutral trade. Does that kind of make sense, the mindset on that? In general, when interest rates are low, we're going to be relatively bullish, and that is the case right now. We also have low inflation, which is perplexing all of the economists. So perhaps the productivity in the last 10 years has outpaced the rapid increase in the monetary supply, which is hard to believe, but we still live in this world with no inflation, and we have the whole world rushing to buy our treasuries. So if you're going to borrow money to buy a U.S. treasury that's paying let's look at the treasuries right now. So the Fed has said that not only do they want to create 2% interest, which, you know, you got to realize they started getting in 2018, and then they raised rates, crashed the markets. We had a world bear market for all of 2018, and immediately they're back to lowering rates and becoming more dovish. So right now we're not looking at what their goals are. Their goals are to go above 2% interest. So let me ask you this: why would you buy any of these options on the Treasury curve if you thought that the Fed was going to hit a 2% interest rate? You want to make 0.2% a year for 10 years? How about 0.81% for 30 years? That doesn't sound like a lot of fun. So what are your options to invest with yields on bonds so low? And so you also got to wonder, why is everybody rushing in to purchase these treasuries right now? Why have the rates dropped? And so we can get into that in a little bit, but essentially you have no option. You end up in the stock market because that's where you can generate a return. So we will be a little more bullish on the covered calls in general, except for when the market's telling us there might be a bump in the next 48 hours. So again, we're not trying to hit 50 to 60% return a year. We're trying to really cut off all drawdown possible and then pull in the easy income as often as possible. Now, why is everybody buying bonds? Well, it could have to do with Stanley Druckenmiller and Ray Dalio and Jeff Gundlach and everybody else scaring the whole world, telling them that they're all buying 10-year treasuries. But the big thing is they're not buying it to make 0.8% a year. Everybody buying bonds right now is just gambling that it's going to continue to go lower. And what's going to happen is everybody's going to try to sell their bonds at the same time for a profit. And I think that's when these rates are going to start to jump. So it's always amazing how long a certain trend can go before it reverses. But that's the basis of this entire strategy right here, is that we do think the long-term rates will rise towards a more historic normal, which over 200 years was at 5%. And so if we overshoot that a bit, the underlying asset in this product, let's look at it. So if I didn't tell you what's going on in this ETF, you might think it's the worst thing in the world. You know, it's crashed from 290 to 32. Why on earth would we want to buy 100 shares of that and write a covered call on it? Well, what if I told you if the 20-year treasury went to 6 or 7%, this would trade at $140? So that's the big picture on our so-called poor man's strategy. But right now, the trade is, everybody is trying to bet that yields will go lower and they're going to make a quick buck chasing the trend. So probably have all the bond kings who got into this the beginning or the middle of 2018 cashing out soon. And I think we're going to see a sharp change in direction on that. Okay, so that kind of covers the bonds relationship to equities and whether we're going to rate the strike above or below the trading price. What other questions we got? Let me see, we got some more people joining us. What kind of trading have you been up to lately, Steve? Did you short that December crash? Oh, nice. Very good. Oh, selling credits. Okay. Let's see. Is there anybody who'd be willing to be a demo today? What I'll do is I'll pull up your spreadsheet, kind of ask you some questions about what you think about the program, what settings you like, which securities you like, and I can start to fill it out for you. And it always ends up as a very good demonstration for the crowd. Steve, are you going to be the lucky guinea pig today? All right. Okay. Let me pull up your spreadsheet. Give me a quick second. Do you have a mic today, Steve, or would you prefer to just chat through the? No, today. Okay. Well, that's fine. I'll just read out loud his comments. So while I'm pulling up your spreadsheet, you know, we're not saying you're going to really do this, but of the strategies we went over today, which one do you like the most? The SPY trade. Okay. Let me pull up your account. So one neat thing about the software we've designed, and this is, you know, admittedly a very just, you know, color-coded calculator. It's not super high-tech by any means, but it's a lot better than what most folks have to start with. Yep. All right, Steve. So we'll start you out. I'm going to pull up your spreadsheet so that this is one neat thing about our program is that I can actually look at your spreadsheet remotely and help you fill it out, fix it. And as we change what I call the palette, the securities we're trading, over time, these will slowly change. Okay, Steve wants to start off with 100K, which is perfect because that leaves us with 300 shares of the SPY and a 10% hedge. So let me, what's your email again, Steve? It's like, if you could, I won't read it out loud to everybody. Just so I can search your spreadsheet really fast. Oh, there it is. Okay. Okay, and if you don't have the most recent one, I'll issue you a brand new one, but let's see. Okay, so this is a slightly outdated spreadsheet, but it does have the SPY setting, so that's fine. And if you want to look at the emerging markets or the breakdown of this one, let me know and I can issue a new sheet. All right, so we'll start off with an initial deposit of 100,000. We're going to, we always want to have a 10% cash position, and I do not ever recommend using leverage. So, you know, let's just, you want me, okay, he says just start over. Yeah, no problem. Okay, so I'm starting off 90% here, 10% here. So you can see, let's see what's going on here. Okay, we got some, he's been playing with it, nice. Okay, I think you started filling out, I'll just start over, no problem. Oh, okay. I think you reprogrammed your sheet a little bit. No problem. Just so you guys know, the only cells that you do touch are going to be the slightly darker. So the rest of it's programmed to auto connect. So this is a common mistake a lot of people make. I think Steve accidentally put his current value at 30K. But the first step is to throw your deposit. So we have a lot of nice tracking for you. You can track your month-to-month return. Let me just issue a brand new sheet and we'll go from there. Because you also don't have the two new templates. Yeah, no worries. It's not a problem at all. So we basically have a little factory software that will crank out Steve a new, fresh new spreadsheet, and it's being generated right now. And then we'll start to fill it out. Any other questions out there while I generate his fresh new spreadsheet?
Yeah, I have a question. If we come aboard with you, are you going to have access to our spreadsheets, or is that something we have to give you access to?
Yeah, we have access to everyone's sheet, and there are hundreds of people hopping into their spreadsheets every day. It's really cool. I can see the action going on. People are really using the platform. So is the privacy possibly an issue? Maybe, but you know, I have no interest in spying on our members unless they ask for help, one, and then two, this has no connection to your real portfolio. It's just a calculator to help you guide yourself. Now, if you did want to save the spreadsheet and put it offline, you could do that, so that's not a problem either.
Okay, so we're looking at a hypothetical spreadsheet here.
This is a real spreadsheet, but it is not attached to their private information or anything that would be.
Perfect. Okay, yeah. Thank you.
Okay, so we issued a brand new spreadsheet, and you'll see from time to time we do change the template. You this maybe like once a year, we'll change the palette. So these are the different products we're going to use to manage our investments. So it comes with some default settings. You can see it's set at 90%, 10, and with a 35K deposit. So I'm going to jump that to 100K, and I'll move it to March. Not that that really matters. Now, let's say you were using this for income. If you were to withdraw money, that's where you would pull it out. Let's say you needed $3,000 this month for all of your bills. Then that's where you would account for that. So this is just an accounting system. Okay, so we did the first step, and it says Trade Alert 319 shares. Well, we don't really need 319, we just need 300. We want even lots of 100, and throw in today's date. Wow, we're flat at 282. That's kind of like when you go to the grocery store and it ends out with even change. That's a lucky sign there, Steve. Now, if you want to fill out this part, you can, but you don't have to. So you can see right away, it knows that I have 300 shares. So another cool thing is, let's say for whatever reason you didn't like the SPY and you wanted to do some other random ETF or stock. Now you can see it says don't do this. It'll warn you when you're doing something you shouldn't do. So it's all automated recognition of the ETF ticker. So you can play with this if you like. Yesterday we had a guy who doesn't like Facebook, so he's going to put AT&T into it. All right, so we've got that. Now let's look at today's trade. So we don't want to just, we're not going for growth. Our audience needs to protect their capital. So we don't want to. All right. Yeah, let me, Jerry is in. Let me add him. He's the fellow who didn't like Facebook. Yeah, let me unmute you there, bud. One sec. Where's my list of attendees? Sorry, guys, I end up with a bazillion different windows open here. All right, let me unmute Gary here.
Hey, you came up here.
A little late to class today, Gary. Just kidding. I think you got your audio now. Do you want to do a test call?
He asked me if he could use my phone. And so I allowed him to use my phone and let him in my house. And I guess he stayed there for a few hours. I don't know. Outside.
Are you talking to us, Gary, or are you Jerry? Sorry.
He just basically left me hanging with his AT&T stuff, and so I've got this box that now I'm responsible for. I have to do something with it.
Okay, I can't quite hear you, but I'm going to go ahead and keep going on and get today's trade in there. So, if we wanted growth, we need to be a lot younger, and we'd probably just want to hold the underlying asset and not do the covered call. But if we're going into retirement and we're possibly at an end of a 30-year low interest rate regime, where we might enter something like the 60s in the next few years, where we have a long-term trend of rising rates, then this is a strategy you need to have because it helps you protect. Oh, hey, welcome, Bob. Bob joined us. Bob was too impatient with his free trial. He just wanted to upgrade yesterday. Thanks for officially joining us, and welcome to the webinar. I don't think he's got his audio. So, okay, so with the mindset that we can't afford to lose money, we don't want to just buy the ticker and just sit on it. We want to always be writing our covered call.
Oh, no. Oh, okay.
Jerry, I'm just going to mute you. For some reason, your audio is not coming out loud enough to quite understand you. I don't know if you were talking to us or someone else around you. So If you do have a question and want your audio unmuted, let me know. All right, so let me pull up today's trade alert and we can look at how to put this on. And I'm going to pull up a copy of today's trade. And so you can see we wrote the 281.50 for a $1.41 credit. Or actually, when I actually placed this, it was $1.35. So let's just use that. So 3 contracts because we have, it's basically like having 3 apartments in a nice apartment condo in New York, and you're using the Airbnb app to generate this income. And the rest of this you can fill out or not. I was using the contract name, but our ability to accurately pull the price live from Yahoo Finance has been very finicky. So we'll get that fixed, but usually we can watch the price live from our spreadsheet right here. But again, that's not that important because we know what's going to happen. Every Monday, Wednesday, Friday, we're going to roll the position. So let's look at how you'd actually fill that out in a ticket for some of us that are new to options. Okay, so first we bought 300 shares. Okay, so that's how you place that order. Next, you go to the option. There's only 2 types of options we're doing on the SPY. So we do okay, so that's your order there, sell to open. So we collect at this point in time $120 or $119 times 3, so about $360. But we go into it knowing that some of that we have to give back because it's below the trading price. So the benefit here is we have a little downside protection, but we're going to get very close to that guaranteed $100 3 times a week. If we get assigned, it's more like in the 80 range. But if we just go flat or slightly down, we may realize closer to that $100 mark. So what do we do to close this out Monday? Buy to close. So this will be a debit. The previous trade was a credit. We take the credit in. We're going to have to pay a debit out to close it. Okay, now a lot of people want to know, well, why don't you just let it expire worthless? Well, the catch with that is you're not going to make rent overnight. You know, we want to rent out these shares every waking day. So we're happy to take, you know, a 98% profit instead of a 100% profit when that is that scenario, because we want to write a new covered call. So, all right, we close that. What do we do next? We go to the next expiration date and we sell to open. So it's a very simple idea. It's a very powerful strategy. And for investors who have between $30,000 and perhaps up to $1 million, it's a very easy way to generate retirement income, protect your nest egg, and be able to quickly react to the market. And what's very notable about this covered call strategy is that you can give yourself downside protection without eating away at your portfolio. You know, anybody's tried to buy put options and predict some kind of crash in either an ETF or a specific security knows just how hard it is to pull off. Okay, Steve says if the SPY drops 20 points over the weekend, you just keep writing calls. Good question. Yeah, Warren Buffett was just on, forgot which interview yesterday. Very good one. And his basic analysis of the market was that it does feel like, you know, the global slowdown is somewhat felt, and that it would not change anything the way he runs his business, and that he hopes he lives through a bunch of recessions. So let's take a look at that. What if the SPY were to drop $20 over the weekend. And so we actually had a period that was similar to that right here. So this is one of the most horrific pullbacks, 15% with pretty much no upside in a very short period from right here to down to here. And so what are some of the biggest drops we saw? We saw from 278 to 270. So that was an $8 crash. By the second day, we had 16. So there's an instance where we did have 16 bucks in a trading period. What about right here? We went from 255 to 245. So there's a $10. And then from here, 246 to 234. So these are some of the moves that rarely happen, but we just saw it in 2018. And so the answer is yes, our portfolio just kept writing the in the money covered calls. We were not betting that it would crash anywhere near that amount. And so sure, we saw some small losses during that period, but a lot less than everyone else. So, you know, in every update, see if you can go look at the track record and see exactly how it performed during that period. One thing that would be really neat would be to show the daily maximum drawdown. We just don't have that built yet. But yeah, you know, to be in the market, we have to realize a potential risk to get the covered call income, and that's what it is. So the answer is yes, unless we really thought that this was going to drop by 50% or something of that nature. We're just going to keep writing the covered call. Now, if we do get worried, there is a plan, and the plan is to have a 9% in the money call option on the VIX, which this is exactly what that is right here. But this is a much smaller position, and I'm going to cover it and give just a single position on the VIX and a single position on the QQQ. So if a number of things happen, number one, if we raise tariffs, certainly our outlook on the market is going to change. Okay. Number two, if the Treasury yield or the Fed starts to rise, that's negative for equities. So we can definitely react to the market environment. But right now we're in a very good market environment for stocks. So I'm very reluctant to put on hedges and also want to write the covered call above the trading price as often as possible. So the quick answer is that we can't protect against all short-term volatility with our covered call. To be able to protect against something of the 2008 nature, the 2000 nature, or even worse, the 60s through the 80s, we're going to have to start using some long options. So we have basically 3 lines of defense to protect our capital, which unfortunately most people just don't have. If you think about it, what happens if the S&P 500 crashes? Well, these companies are going to start doing layoffs. They might start rising prices. The economy slows down, unemployment goes up, real estate goes down. Now the taxpayers have less tax money, so we can't meet our deficits. Now this problem where we have a $1 trillion deficit, maybe it's $2 or $3 trillion. So clearly, you know, what's going to happen if the S&P 500 crashes? Well, what else are you going to do with your money? Are you doing something better to protect your capital than what I've just illustrated? If you go all cash and the central banks are going to do QE5, is that a good idea? Are we going to jump into gold right when the central banks might raise rates? So there's just no, you know, there's no magic cure to protect ourselves. But I would argue that this is probably the best way a small fish like us can react quickly to the movements of the market. And we're reacting every Monday, Wednesday, Friday. The other big difference between us and someone like a hedge fund is that they have to predict big moves well before they happen because they have so much capital to sell or buy. We don't have to do that. We can follow the movement of the market and just go with the trend because we're such small fishes in the big ocean. So that's really the three options that we will look at. A fourth option, let me go to this one. Okay, so what could really stop the US stock market from going any higher? And I think there's one key thing that has to stop before that will happen, and it's corporate buybacks. And another thing I'd like to point out, the biggest corporate buybacks are by far these companies right here. So the buyback index has outperformed the S&P 500. Yeah, bad earnings would do it. But think about the record pace of stock buybacks. The corporation is not too concerned about bad earnings or anything of that nature. In fact, they're more likely to buy their stock. Yeah, inflation. So yeah, there's a long list of problems. But until the corporate buybacks stop, that is a huge, it's like the Fed put. We have two big forces that are protecting stocks. We have the central bank at this moment with low rates, and we have corporations with record amounts of profits, and they don't want to hold cash. Why? Because they think the value of the dollar is going down and they think the value of their stock is going up. So it makes sense to buy back their own stock. So we have a ticker SJB. This is short high yield credit. So this is a good ticker to watch. And when the corporate bond market starts to blow up and the rates start to rise, that's when the corporate buybacks potentially start to slow down. So that'll be another good signal and another way we can play the downside. How are you doing with the program so far, Bob? Have you got your spreadsheet started? Not yet. Do you need any help getting it going, or?
No, I've just got to find some time to concentrate on it first. I haven't had the time.
Okay. No problem. Well, if you ever want to be the guinea pig in class one day and I can pull up your spreadsheet and fill it out for you, no worries. Happy to do, or we could even do that today if you want.
I'll look at it next week.
Okay, sure. Okay, so what other questions we got out there, guys? But yep, Steve's got a good point. Bad earnings, high interest rates, and inflation. So perhaps there's a slowdown in earnings right now. We certainly don't have high interest rates, and there's no sign of inflation. And funny enough, the longer they delay this China talks, that's a big risk that's taken off the table. So at this point, everyone's thinking it's not a problem yet. Now, I in particular am a little skeptical that China and America are really going to be best friends. And so if you study Ray Dalio, he goes back to World War I, World War II. The wars didn't necessarily create the Depression, but trying to get even after the war, all the European countries wanted Germany to pay back all this problems they'd caused. And by punishing them so horrifically for so long, it ended up collapsing the global economy, and we got the Great Depression. So are we going to, we have the same thing. We have this growing power in China that is contesting the American dominance. And is China just going to bow down and say, all right, we'll just keep being the second guy, even though we have 3 times your population? I don't know. That's definitely up for debate. Right now, there's no tariffs, there's no war. They're talking. Rates are low, inflation's low. employment is hot, so we're bullish. And that's just the general theme of the outlook right now in all these portfolios. But can that situation change quickly? Sure. And that's the biggest benefit that our product can offer you is trying to spot out trouble before it arises and once again, play it safe. They can't even agree on the English to China. Yeah, they write up, 100 documents of stuff and it comes back crossed out all in red. Another big thing about China is they're on track to become a bigger economy just selling products to themselves. So the chance for America to bully China was probably 10 years ago, and a lot less the case now. So we'll see. Can they really come to terms and make it work for everyone? That would be great. And if that's the case, we might have, the world's longest bull market continue. So we'll just have to watch that. It's very hard to know exactly what's going on with that conversation and dialogue, but certainly I spend an awful lot of time trying to study the Chinese-U.S. relationship. Yeah, you're welcome, Steve. It's good to have you back. And any other questions out there? We're about towards the end of our 1 hour. Oh, Jerry's got questions. Or Gary, sorry. Jerry, I had it right the first time. Hey, Jerry, how's it going?
Good, Jason. And filling out this, because I've come up with, on this demo trade that I have with Thinkorswim, I wanted to input all my information into the spreadsheet. And under initial prices, do you, for what that underlying is, do you put the price initially as what you paid for it under price?
Yeah.
Or is that an updated thing that goes on just during the day?
This right here?
No, over to the left, where you initiate everything. Yeah.
Right
where
here.
you have SPY where it says 282.10.
Let me pull up your sheet and we'll work in there, okay?
Yeah, sure.
Because I think you had overwritten some of your
yeah. Take a look at what I've got in there.
Okay, let me do me a favor and type your email so I can quickly pull your spreadsheet out.
Yeah, sure.
Okay, got it.
And I have it under, I made the changes under the diamond.
Okay. Okay, so far looks good.
No, I didn't. That isn't what it looks like. Am I able to update this somehow so you're seeing it? Or yeah, because that's not
your old crypto one. Let me see what you're looking at here. Yeah, it's live, so you may have multiple sheets. So wait, is this should be the one?
Yeah, but that's not what I have set up because I changed it around. I was changing around while you were talking.
Right, yeah.
Should I save it or anything on my side or?
Well, I could put the screen on you and then maybe figure it out. Are you comfortable with that? Or would you have me find your sheet and pull it up over here? Do this. Go to the top of your spreadsheet like that and hit copy. and paste that into the chat, and I'll see why
Show.
why we don't have the same link.
Okay, got it. Okay, good.
Okay. Oh, okay, different email address, that's why. No problem.
Yeah, that's it.
Oh, cool. All right, you've been. Now, did you just hide some rows, or how did you?
Yeah, no, I just I deleted them just so I could have those 5 there.
Okay.
Should I have done it a different way?
Yeah. See, look what happened. You got this all crazy now.
Okay.
You want me to issue you a brand new one? I'll help you get what you're trying to do. Let me.
Okay. Cool. Yeah. Okay. Cool.
Okay.
Yeah. What I'm trying to achieve is since I put on these trades starting from I think I initially bought the SPY on 313. I wanted to kind of update this whole spreadsheet with what I have.
Right. So great. And our platform is designed to give you the flexibility to play with the tickers. But what we can't do is actually, I'll show you how to do what you're wanting to do a little bit.
Okay.
Okay.
Yeah, that'd be great.
Okay. So, all right. We want to keep Microsoft?
Yes.
Keep Apple?
Yes.
What do you want to replace Facebook with?
SPY.
SPY?
Yes.
Okay. Do you want Intel?
None of those next 3.
Okay. Okay. You want and no
Yeah.
banks?
Yeah. 500 VAC.
I'm sorry. Tell me the next tickers you want.
Well, it's those 3, and then BAC, and then I'm trading VXBB.
VXVV?
I'm sorry, VXXB as in boy.
Okay.
B as in boy.
Oh.
Yeah, there you go.
Yeah, this is one you were telling me about yesterday, huh?
Yeah.
Okay. Now, are you wanting to use this this security as a hedge, or are you wanting to use it as a way to generate income?
Well, I think it's going to achieve both, is what my thoughts are. Like I just started it last week, and I just collected like 1,500 in premium because it's expiring worthless.
Yeah, yeah. Shorting volatility is a popular strategy. Okay, so you want to just treat it as part of the normal grouping?
Yeah. Yeah, I bought.
Okay.
Yeah, I have 1,000 of those.
Okay. So you just want these 5 total tickers?
Yeah, that's it.
Anything else?
Yeah, it's all my mind can handle, I think, right now.
Okay, sure. Let's just okay, so we'll just I want you to just ignore all the other stuff. We're just gonna use the blue, okay? Okay, what's the starting capital? 150, is that right?
Yes.
Okay. All right. Now, what? How many shares of each of these do you want to use?
Starting with Microsoft, 100.
Okay.
Apple's 100. SPY's 100. VIX is 1,000. And VAC is 500.
Okay. All right, so now you're set to jet.
Okay, and then as far as entering the initial price,
Yeah, do you have a price per share?
yeah, I can run through those real fast.
Okay.
Okay, Apple traded, I just bought that today, 189.07.
I'm sorry, what was that?
189.07 for Apple.
Okay.
I'm just going alphabetical on my thing. BAC, I'm not looking at you, so I'm just looking at this. But,
Sure.
BAC is 27.31.
Okay.
Microsoft 117.39.
Okay.
SPY 280.65.
280.65?
Yes.
Okay.
And VXXB was 28.76. Or excuse me, 28.76. Yeah, I'm sorry, 28.76.
Okay.
And you know what? Throw in the TBT there too, because I do have this on this demo account, the TBT. So let's add in the TBT.
Okay. I'll throw TBT up here, okay?
Yeah, that'd be great. And I got 500 of those.
Okay, well, price?
At 35.17.
Okay, so let's see, what's going on with this? Let's see what's going on up here. Something got a little funky on this. Oh, okay. Yeah, these are supposed to be percentages. Okay, so now let's talk about the,
You have
is this the relationship of,
you have two BACs instead of TBT yet.
what's that?
You have two BACs instead of TBT.
I got the TBT here. Yeah, I gotta get rid of this Bank of America. These will just be optional later,
Yeah,
just
okay.
so it doesn't overwrite it.
Yeah.
Okay, so now let's look at, so here's the target percentage that you've managed to get. Are you happy with the ratio of those different positions? Let me rephrase that. Do you like the allocation you have to each underlying asset to remain at these relationships?
Pretty much at this point, because I'm figuring that Microsoft's kind of included in the TBT.
Okay, so let's go 8, 12, 19, 19, 9. See, does that work? Almost did. Oh yeah, it's not quite. All right, so target. Okay, so this would be. We got close.
What is the weight?
The weight is helping figure out what the relationship of how much security we own relative to our total portfolio. So this helps you make sure you have the right amount of shares. So the way it was programmed is to try to mimic the S&P 500. But you're going a little, you're optimizing, and that's what the software is all about. So there's nothing wrong with that. So I've kind of just reverse engineered what you want right here. So that's pretty close. How's that look? So this is trying to target a 10%. So this is saying of all the money you have, what percentage of it should own each of these underlying assets? And so if you ever get assigned, I mean, it's pretty easy math to start with. Like you already know, that's what you're doing. But I've at least reconfigured this to track what you're telling me you want to do. Does that make sense?
Yeah.
Okay, so we got control of the TBT up here in the green area, and then we have these unique securities that you've chosen right here. So the next step would be to start filling out your covered calls. So open positions you fill in right here, and then when you close them, you push it down to here.
Okay. Can you go through that one more time, about as far as pairing and?
Do you have any, you want me to go over how to do this part right here?
Like if, yeah, as if,
Tell me about the trade you have on this VXXB.
okay.
When did you enter that position?
Let's say at a 31.5 call at 31.5, March 29 was the first one.
That's the expiration or the,
Yeah, that
okay.
actually I entered that, I'd say on the 22nd. It would have been a week. So the 22nd would have been March 29.
So you entered it on 3/22 and it expires today, right?
Yes.
Okay. So date entered is 3/22, expiration date 3/29. What was the option premium you collected?
God, I'm trying to find that. Trying to get that here. I'm still trying to. Oh, here we go. There, 120.
And let's see how many contracts you did. 10.
Yeah.
Okay, now you're going to close that today, right? And roll it over. So let's do that.
Actually, I'm just letting it expire.
Okay, well, same difference. So it'll expire today. So let me. It's going to expire for 0, I presume. So now let's assume that it's next week, okay? So you're going to probably open a new one on Monday.
Actually, I did. I sold 10 today
Okay, great. So
for April 5.
yep. What strike?
29.5
Okay.
at 85.
Cool. Now, do you have any of the trades on the other underlyings, or you just been doing the VXXB?
I can give you. Yeah, I just opened up BAC, Apple, and Microsoft today. I can give you those real quick.
Okay.
On the Microsoft, is April 5, 118 at 84 cents.
Okay. One contract, right?
Yes.
Okay.
5 BACs, April 5 at 58 cents.
What was the strike?
The strike was 27.
Okay. And the credit? I'm sorry, I forgot.
58 cents.
And 5, right?
Yes.
Gary is killing it. He's already sitting on a $3,000 profit in a week. So this is a very popular trade. Just, fair warning. This is the trade that's going to blow up, the VXXB. So don't use all your portfolio and enjoy it, and just be careful and maybe look out for, if I think there's a major volatility spike, that'll be your cue to pause on this trade. In a previous program that Steve was part of, we were trading a lot. This was one of our favorite trades, was to short the VIX whenever it'd spike. So yeah, I'm well aware of that trade. It's addicting. It's easy, and but they call it the you see all the ants marching up the anthill, and then what happens? They fall into the anthole. So just be careful with that one. Is the only caution I would recommend on that one. And don't use your whole portfolio on it.
No, that's kind of why I have it. Wait, set kind of.
Yeah, you have a good diversification here. So look, you only have 30K out of 150 in that one. So that makes sense. It's a very attractive trade. It's a little more aggressive than I wanted to put into our product for our average Joe. But I can tell you, I've done that a lot of times. And what I like to do with that one is wait for it to spike the VIX and then short it all the way back down to normal level. But yeah, that's one of the most popular trades out there right now with advanced traders.
I guess I'm looking at it as, really to catch those spikes like this, this last week that occurred.
Yeah, it's a good play, but it's high risk, and you might want to hedge that position with like a long call on the VIX or a long out of the money put on the QQQ. Something like that would make you feel a little safer at night, being exposed to that position. Because it's not like the S&P 500. We know the S&P 500 is going to create profits for decades to come. So I'm not worried about getting wiped out in that position by writing the covered call. But a big, huge volatility spike could cause some serious damage in anything that's shorting volatility. So we know with almost certainty that volatility spikes do happen. And so that's something that is going to happen at some point. So can you mitigate that risk and clean up for the rest of the time? That's what a lot of people are doing. A lot of big money is doing precisely this strategy. And that's what's neat about our platform. Look how easy it is for you to manage that trade.
Yeah, on the 1,000 long though, that's where, don't you think it helps me on a spike? I mean, because I'm long 1,000.
Yeah, but let me look at that one. What is this? Oh, okay. So this is a bullish. Okay, my bad. I misunderstood what this product is. So I was doing the opposite of this one. Yeah. So okay.
Yeah, this is like inverse of the S&P practically.
Yeah. Okay. No. All right. So yeah, I was doing that. Here's what we were doing. This is a very popular strategy. Is wait for any kind of volatility spike, and then do the bear spread.
Yeah, I get that. And I wanted to stay away from the VIX itself, and when they had the VXX, but they changed the VXXB, so that's what had me interested in it by looking at the chart, the VXXB.
Cool. So yeah, I like your diversification. I like your securities, and you saw how easy it was to manipulate this. If later on you wanted to add some positions here, we could do it. You liked AT&T. Is there any other stock you'd want me to throw in just so it's there in case you want to add it? You still got 30K in cash.
I think probably what I was going to do, Jason, was going to add. My thought was more to add on to what I had. I kind of want to keep it simple within what I have to execute.
What about
I mean, that would be those two you have there. I would leave. I would probably keep Wells. Yeah.
What about like emerging market gold for that area? So you're kind of taking all three of our products and putting it into one. I like it. Let's just say we want to put a little capital here. Let's say we got 15K. So, oh, that almost works out perfect if I think if I go 10%. Whoa, this thing went crazy on us. Oh, for some reason your thing lost the percentages. So this might give you, you don't have to do this obviously, but.
That looks kind of good.
Yeah, a little more, a little more diversification and some exposure to precious metals. Actually, we're doing GDX. So at least, some of these tickers are ones that I'm tracking, so you have a good idea of where the strike would be. So let's see, we still got 30K cash. We need to buy some more shares. Okay, let's go. Oh yeah, that's fine. There we go. Now we have just enough cash. We got some emerging market metal, precious metal exposure. And now we need to go add these right here. How do you like that?
Yeah, I do like it.
Yeah, it looks pretty good. It's a nice little twist you put on it. Cool. So let me fix your.
And those numbers will all change when I plug in all the options.
Yeah, it's all dynamic. So in general, if it tells you don't edit, it means don't edit. I've color coded the spreadsheet, so darker cells you get to play with, the other ones you shouldn't, unless you really know how the coding works in the spreadsheet. So if you want to fine tune your spreadsheet, I'm happy to do it for you guys in these live webinars. It really provides a great education for the rest of us. And let's see how many people are still listening. Oh yeah, still got everybody out there. Any other questions out there? And I'm not trying to cut you off, Jerry. Let's just see if anybody else has any questions.
You bet.
Okay, I'm just cleaning out all these questions so I can see if there's any fresh ones. All right, any other questions out there, guys? What about you, Jerry? Any other?
Can we fill in the Apple?
Yeah.
Strike?
Okay, what strike?
It was April 190. April 5, 190.
Okay.
184.
Okay. Did you do your SPY?
Yeah.
Okay.
These were just rollovers. But I rolled over a 279 for a 25-cent credit.
Okay, wait, so Okay, so what was the first trade you did? So you entered on 327 expiring today, right?
Yeah.
What strike?
I'm sorry. Is it 279?
Okay. And the option credit?
At 25 cents.
Okay. And you rolled it over for a penny?
I'm sorry.
Oh, so what did you have to pay to buy it back?
Gosh, that's a thing on this thing. It's not. It doesn't. It since it rolls it just tells you what your credit is.
Oh, so you netted 25? Okay, I can make that happen. We'll just put 0. Okay, now what's the new position you put on?
Yeah, that was the April. I'm sorry, that was the April 1st call on a 25-cent credit.
Oh, okay, so that's the position you're in right now.
Yeah, that's what I did today.
Oh, okay. So you don't have a closed covered call position yet, right?
Only from the beginning, but I don't want to have you go all the way back from
Okay.
the beginning.
Let's see what your net profit is so far. It's been a good week, 3,600 bucks.
Yeah, I would say I would be happy with that week.
Yeah, I'm sorry, I hope so.
Yeah.
Yeah, you compound 2% a week. You're, that's quite a, what is that, like, who knows, 150% return?
Wow, if that were only real money right now, Jim.
So I'm just saying 52 years, but I mean 52 weeks. Let's just say 2%. Holy cow, that's more than so you probably won't be able to maintain that for much longer without, taking on some crazy risk, but yeah, you can't complain.
So the only thing you think is crazy risk is having that VXBB, huh?
No, you know what? I thought you were doing the opposite. So that provides a good hedge. The problem is the covered call is going to block the hedge when the risk comes. And the same is true with that TBT. But yeah, it's a very interesting product. I'll definitely look more into it and consider how it might play a part in some of our other portfolios. But in general, we don't want to write a covered call on the part of our portfolio we're trying to protect with. So that's definitely something to consider. But because I don't think the S&P 500 is going to collapse anytime soon, we're not really worried about that. And you're just making a huge income with that one. So I don't have a big critique with your portfolio at all.
Yeah, I guess that's what my thought was. It was just in looking at the premiums and stuff with that VIX, and I just thought that it might be a simple way to collect premium at the same time, for protection in case, you just wake up and something happened over the weekend bad.
But see, then you're going to be assigned. So if you write the covered call, it doesn't provide that. So in general, I like what you did. I don't think it's terrible to put that VX, the inverse VIX, I guess is what that is. It seems like just a great way to generate more income with this kind of oddball ETF, and it's kind of like the TBT trade. So sure, yeah, that works. You got most of your capital holding real companies that generate real profits that we know will be around, and I can tell you get it. You get how the program works, what the strategy is. So now we got to worry about not losing money. So you understand how to make money. That's not hard. But how do we sidestep any kind of disasters? And so that's where we go to next, is just keeping a lookout for that and being on our A game. So yeah, you just saw how easy it is to kind of play with this.
Well, I guess I should go in and buy EEM and GDX on this
Yeah.
trade account, just to have matched up.
Yeah, let me know what price you get.
Okay. And real quick, you had 200 on that EEM, right?
Yeah. I'll be right back in 2 minutes. I just need a quick restroom run. I'll be right back.
Okay.
All right, I am back.
Okay.
Now, did you do a covered call on your TBT already?
Yeah, I did. Let me get today.
Just guessing. I don't know what you got.
I sold the April 5, 32.5
Okay.
and for 44 cents.
All right. Even better. 4,000 profit.
The other TBT was on 322.
Okay.
It was the 33 call at 42 cents.
And you just let it expire? Or is that your final credit you got?
Yeah, I just did like a roll.
Okay. But your net credit was 42? Well, you could go tweak it. I think you're starting to get a feel for it, right?
Yeah,
So what we don't want to do is delete rows, edit formulas and such. So if you do want to change your template at all, best bet is hop on the webinar and I'll reprogram it for you and teach everybody at the same time.
Okay.
Okay, how did you get $1,000 profit on the SPY? Jerry G asks. Let's look. So Jerry, are you looking at the spreadsheet I'm on right now?
Am I looking at the same spreadsheet on my side that you're looking at? Is a question?
Oh, sorry. There's another Jerry on there who's watching. So he asked, how did you get $1,000 profit on the SPY? So where do you see 1,000? Oh, right here. Okay, so that is looking at he purchased shares. No, I have to. Okay, so this is looking at all the credits and the change in the underlying to calculate the total profit. So we'd have to break that down, but let's see, we got, what do we got? $2 times 100, so 200 there. We don't have any. Okay, so yeah, something got funny with this part, Jerry, when we're doing this. So let's just ignore this. Messing around with this programming, I'm not sure exactly what this is pulling right here, but we can look at the underlying sale total. Then we can look at the current value of our assets. And then we can look at our total credits received. And that's how it's calculating our profits. So we have credits that we're totaling right here. We have these two credits. So you can see the bulk of his profits are right here in this covered call writing. 1,400. So that's 3,000 in credit right there. And then I believe there's some appreciation in the underlying asset. So that's how it's adding up to the 4,250 profit. But yeah, there's certainly a mistake in the calculation right here. So I'll look into that. This is trying to, before I went and reprogram this template, is trying to look at the profit per security over time when it accounts for all the buying and selling. But this is accurate up here. But basically, he bought low, and the market's been rallying pretty hard for the last 3 days, so his profits look really nice. Market goes down. If we've written our strike prices below the market, we can still look just fine. But in some cases, that's not always the case. So, which program are you looking at, Jerry G? Which strategy seems to make the most sense for you?
I'm sorry, but I just got interrupted there. What did you ask me?
Oh, there's another Jerry G has been asking questions. I was just seeing which strategy he likes the best so far.
Okay, so wrong, Jerry. All right.
My bad. We're probably about to wrap it up here, guys. I definitely enjoy these webinars, but we're running out of little time. And any other questions out there?
Oh yeah, just on when I do these updates on the SPY and stuff, Jason, if you could just show me really quickly, like where I'm gonna put these, what I've done so far.
Sure. Okay, so so you put all your closed trades down here and all the open positions up here. That's just to keep track of what's going on.
So it doesn't matter what order it's in, like, how it's done down below.
Nope. So software, number one, it scans the tickers. So in this area, only thing our calculator does is it looks at the net credit here, which can be positive or negative, and it looks at the credit you have an open position in, and it counts that as part of your profit loss. And in this area, it is looking at how many shares you have and flowing it up to here. So, this is not some sort of rocket scientist platform. It's a very simple, easy, repetitive, glorified calculator is really what it is. It's just a nicely color-coded, semi-automated way to do a very long-term covered call strategy and keep track of your results.
Yeah, it's good because that's one of the things I guess in doing this has been confusing is trying to figure out if or what I'm actually making. Like
Right, yeah.
Thinkorswim, it's like I have all these trades on it and I've done all this stuff, but I don't really get how I'm up.
Yeah, you don't know what your net result is, yeah.
Yeah.
And so you got to always remember too, guys, if we do a in the money covered call, it's going to artificially increase our return on investment a little bit more than the real cases if we were to have to actually be assigned. So you'll have a better idea of what your real profit is the moment you cover all your covered calls and then before you put on the new covered call. So it's kind of a clearer idea of once you're no longer hooked to an option contract.
Okay.
Now, if we write the covered call above and then the underlying's going up, it'll also seem like we've made a little more than we really have, because once we have to get rid of the covered call, we may potentially lose some of that profit. So the truest value of your portfolio will be that moment where you cover your position and you can see where you're at, and then you go right into your new position.
Will it, is it a bad idea to just add in the credit if it's just a credit on a roll?
So what, your platform has like a roll position button or something?
Yeah.
Cool. Well, the way our software is designed is we take a credit to put on the position, and then we have to give a debit back to sell the position. And so what you're doing is fine. The way I would do it is basically, so you're getting the net credit between the two trades, I guess?
Yeah, from the 279.
Yeah. So at the end of the day, your entry is going to look like this down below, whereas mine have a buy and a sell price.
Okay.
So yeah, once you roll it, that credit is probably what you got on the last one. So yeah, I'd have to see what exactly you're doing to have a better idea. But if there's any kind of statement or screenshots you want to send over. But typically, it's 2 trades and 2 entries.
Yeah, I get it. Yeah, well, I probably have to make more note of that if I do a roll, like, what it was at when I sold it and what I actually bought it for.
Yeah, that would format better into our platform for sure.
Yeah, right, to create that 25-cent credit.
Yeah, because it seems like it's confusing. It's combining little confusing. Now all of a sudden you have 3 trades connected because it's like they're all linked together with this platform. So
Yeah, I think that's probably where I was getting some of my confusion too, and tracking this stuff from this account. But yeah, I'll try to clean it up on this thing now that you have this set up like this.
yeah, you're ready to rock and roll now.
Yeah.
All right, gentlemen, thanks for your time. Hopefully get all you guys back on Monday. It's really a pleasure to talk to you guys and help you learn how to use the platform. And I hope everyone has a great weekend.
Thanks, you too.
Thank you.
Bye-bye.
Bye.